Everyone says AI is about to conquer Wall Street, smarter than human traders, faster than algorithms, a machine that can read every headline, every tweet, every heartbeat of the market and turn it into profit. But here's the paradox. The more intelligence we pour into markets, the harder true intelligence becomes. If everyone has the model, what's left is the noise. And noise, dressed up as certainty, can be lethal. Markets were never just about prices. They were about stories. For centuries, people told those stories with rumors and chalk marks, with whispers in coffee houses and the rustle of banknotes. Today, large language models write the stories and then trade on them. Machine vision scans the sky for tanker shadows. Reinforcement learners shove orders through the microsecond jungle of modern exchanges. The marketing pitch is simple. More eyes, more speed, more truth. But markets never asked for speed or eyes. They asked a crueler question. What's signal? What's noise? And who gets crushed when we confuse the two? To see why AI feels both inevitable and dangerous, you don't start with GPUs. You start with a slip of paper, a promise. In 1694, the Bank of England turns war and taxation into bonds, and London invents something miraculous, a stream of information about the future. For a long time, that stream is human and slow. Messengers on foot, letters by ship. Then, copper wire stitches the world together. The telegraph compresses space, the ticker tape arrives, and finance teaches a new trick. Markets can read themselves. Then paper clatters through mechanical mouths, printing a river of prices day and night, and suddenly there's a data set where before there were only stories. Time, price, volume. It looks like a heartbeat. Quants spend the next century asking whether that heartbeat contains prophecy. Does news move price, or does price anticipate news? Do yesterday's patterns whisper tomorrow's returns? Can the tape, if you listen long enough, murmur the future? This is the origin myth of every AI fund. Data appears, someone claims it hides truth, someone else builds a machine to sift the truth from the trash, and then someone mistakes correlation for cause. By the 1960s, the lab coats arrive. Portfolio theory, factor models, risk parity. The promise is intoxicating. If you can measure risk, you can domesticate it. Value, momentum carry, term premiums. Tidy concepts with the smell of science. For a while, the machine hums. Then a familiar drama unfolds. Long-term capital management salts its models with genius, levers belief into billions, and aims to harvest tiny mispricings that the rest of the world is too slow to correct. The danger isn't that their math is stupid. The danger is that the world described by their models largely exists because everyone believes it exists. When that belief cracks, when liquidity turns out to be a mirage drawn on the desert floor with other people, zest confidence, the world changes faster than the equations can breathe. The spread that always converged suddenly yawns wider. The risk that was supposed to cancel itself compounds. Intelligence isn't toppled by ignorance. It's toppled by its own reflection. Markets aren't physics. They are reflexive. The act of measuring changes what's measured. Once a strategy becomes the story becomes the price, and the signal decays into noise while the noise dresses itself in the clothes of signal. Then the model breaks. If you've pledged your faith with leverage, it breaks you. The next era worships speed. Exchanges become ecosystems. Order books are no longer lists. They're landscapes with peaks of liquidity and valleys of fear, and microstructure turns into terrain that can be mapped and mined. Small models chase tiny edges across microseconds. They win until they don't. On an ordinary afternoon, the screen goes white, and then black, and then white again. The flash crash teaches an embarrassing lesson. Liquidity can be theater. Resting orders that vanish on contact create the illusion of depth. Presence isn't commitment. When stress hits, the bid that looked solid is just a ghost. And if your model treated ghosts like granite, the fall is fast. A few years later, a single software flag sends an entire firm into self-immolation in under an hour. AI promises to see through all that. It promises to distinguish depth from stagecraft. But speed doesn't eliminate noise. It multiplies it. At microsecond timescales, even randomness has structure. Given enough data, a model will find the structure. And if you aren't careful, you'll bet the firm on a mirage with very convincing geometry. Then comes the age of alternative data. The ticker tape becomes a fire hose. Credit card swipes murmur revenue. Satellites track shadows around refineries. Smartphones leak foot traffic like confetti. Social media coughs up sentiment, sarcasm, and fear in equal measure. AI thrives in oceans, and this is an ocean. Feed a model enough raw material, and it will hand you patterns you didn't know to ask for. It will tell you that the shade of a roof, the density of a parking lot, or the cadence of an executive's voice correlates with next quarter's beat. Sometimes it's right. Often it's almost right, which is worse than wrong. The ocean contains everything, but when you pour everything into a model, everything has a chance to matter a little. You trade variance for 1,000 pathways to fool yourself. The thing you crave isn't correlation, it's causality. You want a chain from this observable to this cash flow to this price under these constraints. But as the data set expands, The causal thread phrase. You start predicting revenue from shadows because last quarter it worked. You convince yourself that a trending phrase will move a stock because last time it did, and forget that last time you were part of the movement. More data reduces in-sample doubt. It also expands the space in which you can make very confident mistakes. Then language learns to think like a machine, or at least to sound like thought. Large language models devour filings, earnings calls, research notes, and headlines. They can summarize an hour of corporate theater in a sentence. They can score tone, detect changes in guidance posture, cluster 1,000 small stories into one big one, and draft the first paragraph of a trading thesis before the coffee cools. For markets, creatures of narrative, this feels like a superpower. Prices digest information. If you digest faster, you should win. Two old laws step in like quiet bouncers. First, when a measure becomes a target, it stops being a good measure. If LLMs reward confident language on calls, management teams will learn to speak the way the machines want. The signal dies the moment it becomes the strategy. Second, narrative is reflexive. These models don't just read stories, they write them, amplify them, and smuggle them into price action. If thousands of partially automated funds nudge exposure because the same language model says the same industry is positive this week, the sentiment can become the trade, and the trade can become the price. You think you discovered signal. In truth, you manufactured it. It's a circular mirror. The model polishes it, but the reflection is still you. None of this means the tools are useless. It means their native habitat is triage, not truth. Use them to compress. Use them to rank. Use them to catch angles you would have missed while reading Note 87. But if you let a language model tell you what S real without asking why it should ever be real, you've exiled judgment and replaced it with a very articulate echo. There are creatures that hunt in the fog between signal and noise. Name them, and you might keep them at bay. One is regime shift. You trained in one climate and deployed in another. Volatility compresses, then explodes. Correlations invert. The feature that screamed by for 5 years now says nothing or lies. Deep models are brilliant at learning the surface of a regime and terrible at warning you when the tide changes beneath it. Another is alpha decay. In markets, adoption is erosion. Every edge attracts imitators and AI accelerates imitation. What once took a year to reverse engineer can now be cloned in a week. Your signal melts not because it is wrong, but because it has already become the price. Leakage and labeling are dull names for sharp blades. In supervised finance, your truth labels are contaminated by later information or rotten with proxy. You thought you taught the machine earnings momentum. You actually taught it a cocktail of post-earnings drift, calendar quirks, and accidental look ahead, pristine in-sample, pain out of sample. Then there is reflexive feedback. Any model that takes action changes the very world it predicts. Routing logic reduces spreads until enough agents route the same way and predators learn to spring traps in the gaps. Success becomes bait. The last specter doesn't ride as much as whisper. It is optimization theater. Loss keeps falling in backtests. Features keep adding a little sparkle, and you start to believe that a better optimizer equals a better theory. The smile of a backtest is not a promise. It is a siren. So what still works? Sanity, built like scaffolding. Start with a causal story, not a fairy tale about destiny, but a map of who pays whom, why, when, and under which constraints. Cash flows are not shy. They tell you where to look. The model is a microscope, not a mystic. Put the microscope where the tissue matters. Respect the hierarchy of clocks. Markets speak in seconds, days, quarters, and years, and each dialect carries different truths. A feature that matters in microstructure may be irrelevant in a cycle. Combine clocks without letting any one clock blackmail your risk. Trade point estimates for distributions. In markets, certainty is fantasy and humility pays in basis points. Ask for spread, not just center. Tie position size to confidence, not to desire. Worship orthogonality over novelty. Everyone chases new, few pursue different. A small, real, uncorrelated edge outlives a gleaming monster that everyone can see from space. AI can help you hunt for orthogonality across text, images, and flows. If you ask it the unglamorous question, how little do these signals overlap? Choose robustness over accuracy. The world will change. The more delicate your features, the more the world will punish you. Prefer coarse, ugly, stubborn signals that survive, regime shifts to beautiful, brittle ones that sing until they shatter. Validate like an enemy. Assume the future intends to break you and test on time periods where your theory should fail. Train on the easy half. Judge on the ugly half. If it dies there, it will die where it counts. Keep a human everywhere. The distribution's shape can change. Leverage, concentration, liquidity commitment. Machines find patterns. Humans must own ruin. Build your kill switches the way submariners build hatches, assuming water will come. Circuit breakers that shrink your footprint when inputs drift, when uncertainty spikes, when drawdowns breach. Graceless exit is better than graceful bankruptcy. Survival is an edge. It compounds. The cult of omniscience is the most dangerous religion in a data-rich world. AI evangelists promise that if you see everything, you'll know everything. Markets punish that fantasy. Seeing everything can mean understanding nothing, because the market is not a crossword puzzle with one correct grid. It is a crowd responding to the last answer it believed. A model that reads all headlines may be worse than one that reads the right headlines, because the price of noise isn't just compute, IDS conviction. Overwhelm manufactures false precision. You can drown in facts and still die of ignorance. Information is not insight, and insight is not edge. Edge is insight that others cannot or will not act on at the same time you do. AI compresses the time between discovery and imitation. The only moats that survive are a different theory, a dataset you're allowed to use that others can't obtain, or a different willingness to hold when the world screams at you to sell. Better if you can manage 2 out of 3. Where does AI shine reliably? In work that doesn't make headlines? It is the plumber that cleans, deduplicates, and aligns filthy data across sources and clocks. The tool that fixes timestamps and rips survivorship bias out of your training set is worth more than the model that generates a viral chart. It is the triage nurse in a frantic hospital, clustering 100 small headlines into one actual shock, spotting that 10 bland updates describe a single supply chain fracture. It is the hygienist in microstructure, predicting execution risk, teaching you when to slice, where to rest, and how to avoid being the liquidity someone else needs. Those wins are invisible and relentless. They compound. It is also your internal auditor. Global models that explain your local models back to you when you least want to listen. Feature attribution under stress. Drift detection that points to a specific vein of poison. Counterfactuals that say, if we had ignored tone and relied on guidance-only features this quarter, our drawdown would have been a third smaller. Risk storytelling that turns technical failure modes into phrases your future self will respect. This edge relies on that friction remaining. And if this policy changes, shut it off. Not romance, survival. One more layer hides under the technical. Permission. If your edge comes from data that was never meant to be sold, if it violates privacy or scrapes where it shouldn't, it will collapse, with fines, subpoenas, or the headline that turns off the tap. AI magnifies temptation because it can wring meaning from crumbs. Don't build castles on stolen sand. Reputations are also collateral. If your cleverness looks like manipulation a year before a regulator decides it is manipulation, the countdown has already begun. Durable edges obey tomorrow's rules, not just today's. Humans love to blame models for overfitting, but we overfit to stories with even more devotion. We overfit to the narrative that flatters our priors, to the guru who sounds like us, to the backtest that solves our fear. One year, retail flows are the signal. The next year, inflation prints are the signal. The next year, AI itself is the signal. Every cycle tempts us to believe the master key has finally been found. There is no master key. There are rooms within rooms, regimes inside regimes. The best investors aren't the ones with the most intricate models. They're the ones who know when their favorite model belongs in the drawer. Intelligence doesn't conquer uncertainty. It coexists with it. The job is not to eliminate noise. It's to build a system that keeps breathing in it. That means boredom and discipline. 2 things. Markets punish in the short run and reward in the long run. It means refusing to let a perfect chart seduce you away from an imperfect process. It means remembering that drawdowns are a feature of price discovery, not an indictment of truth, and that your true edge is the ability to suffer variance without losing the core of the thesis that actually links cause to effect, which brings the riddle to its last turn. If everyone can license the same foundational models, scrape the same web, tune on the same filings, who wins? Those with differentiated data they are legally and ethically allowed to use. Those with operational discipline so clean that research pipelines don't leak, error budgets are real, and de-risking triggers fire without debate. Those with theory deep enough to say no to a perfect backtest, because the causal chain inside it is fairy dust. Those who treat models as instruments, not beliefs. Democracy decides who governs. Markets decide who survives. Survival goes to the teams that can tolerate tedium without chasing noise, and humility without surrendering conviction. Iron lungs, not magic bullets. A refusal to die where everyone else believes immortality can be rented by the GPU hour. Politicians promise stability. Engineers promise control. AI promises omniscience. Markets accept none of those promises for long. The point of artificial intelligence in markets is not to reveal a secret the crowd cannot see. It is to help you see the crowd more clearly and yourself more honestly. Use models to narrow ignorance, not to inflate certainty. Let them read the world, but never let them define it. The signal is not the model's output. The signal is the part of reality that remains true after the model has failed. Because it will fail. All models do. The question is whether your process survives that failure with enough capital, clarity, and courage to keep playing. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.